Good afternoon, everyone. My name is Jeff Olsen, and on behalf of the Landscape Ontario COVID-19 Task Force, I would like to welcome everyone who's joining us today. In a few moments, you're going to meet our panelists who come to us with a wealth of knowledge on today's topic, which is an economic update from recession to recovery. But before we get started, I just wanted to open by saying what a crazy last 12 months it's been. I'm sorry to be so obvious on that. But if we think back to last year at this time, most of us were planning our March break family vacations, living our normal lives, oblivious to the tsunami that was headed our way. In most of our businesses in this industry, our greenhouses were beginning to fill up with production. We were meeting with clients to finalize contracts for spring and summer landscape jobs and getting ready for what was probably just going to be like just an okay year. What actually happened was that after a record low sales month in April, the season took off like a rocket. The unintended consequence of keeping people locked down at home was that they would quickly gravitate to projects around the house. Our industry has benefited greatly from the pandemic, and it's not uncommon to hear that many of our members of Landscape Ontario and our National Association had their best year ever. But where's it going from here? How should we be planning our businesses over the next 12 to 24 months? That is what our speakers hope to shed some light on for us today. So without further ado, please let me introduce them. First, we have Craig Wright, who is the Chief Economist for the Royal Bank of Canada. A graduate of Wilfrid Laurier University and the University of Toronto, Craig was appointed Chief Economist in 2001 after having joined RBC in 1994. Craig is a participant in a number of RBC internal committees and is a member of the C.D. Howe Monetary Policy Council, Lazardis School of Business and Economics, Wilfrid Laurier University, Dean's Advisory Council, and the British Columbia Economic Forecast Council. Craig and his wife Susan live in Toronto with their 3 children, Emily, Bradley, and Jacob. Second up is Dr. Charlie Hall from Texas A&M University. Dr. Hall grew up in the industry on a nursery in Western North Carolina. Although an economist by training, he's currently professor in the Department of Horticultural Sciences at Texas A&M University and also holder of the Ellison Chair in International Floriculture. His major areas of specialization include innovative management and marketing strategies, financial analysis and benchmarking, and situation outlook for nursery and greenhouse crops. He's an invited speaker at numerous regional, national, and international meetings of various industry-related associations and organizations. So, folks, we have 2 amazing presenters today, and we only have an hour. So the format is going to be 2 15-ish minute to 20-minute presentations, followed by a Q&A. Please feel free to ask your questions in the chat, and we'll try to get to as many of them as possible later in the hour. So without further ado, Craig Wright, please start us off.
Thank you, and welcome everybody. In terms of the economic commentary, I'll keep it kind of short because I think in an environment like we're in today that there are arguably more questions than answers. So I want to leave lots of time for discussion at the end. In terms of our economic outlook, as Jeff suggested, we're in a period of transitioning from recession to recovery, and that transition is still tentative and still vulnerable. So right now, the focus is all about the race, if you will, between vaccinations and the variants, and that's going to dictate public policy response in terms of how long parts of the economy remain closed and how quickly we can reopen, not just in Canada, but around the globe. And it's at a varied pace, and it's going to vary across the country as well. But as we go forward, we do see growth prospects picking up as we get the critical masses vaccinated, as we move into the second, third, and fourth quarter. And that'll set the stage for much stronger numbers as we move forward. In terms of, we look at a global outlook, finally we've seen after about a year of downward revisions, global growth prospects, we're starting to see those trajectory lines turn higher. So revisions are now moving to the upside, and the IMF just recently came out with their latest number. And again, upward revision from what we saw in the past. So it looks like we're past the weakest point. And when we look around the globe, most economies are starting to surprise on the upside. Obviously, China had that V-shaped recovery. Other parts of Asia are tagging along on that ride. We're also seeing surprising resilience and strength in the US and in Canada, and that bodes well for growth prospects, likely a little bit better than many had thought or even feared a short while ago for the first quarter. And then I think more convincing numbers as we get into the second quarter and arguably more importantly, the second half of the year. So growth prospects are improving globally. That means trade's going to improve, exports and anything related to exports has already shown a pretty sharp snapback in growth as this was more a service sector recession than a goods sector recession. So we're seeing manufacturing sales, manufacturing shipments in Canada all snap back to pre-crisis levels. Manufacturing employment's recovered most, if not all, of the jobs lost through the crisis. So we're starting to see that translate into stronger exports. The strong global growth is also raising a number of key commodity prices. We see it lumber setting new record high, copper strong as well, nickel soaring. We've seen oil prices a multiple of what they were only a year ago, albeit at their lows. But this is all raising some concerns on inflation. That's something to keep an eye on as we go forward. The inflation risks and the recovery right now, it looks more like demand recovered a bit quicker than supply. Supply will catch up, and that should level it out. But it will be a firm commodity price environment through the course of this year. And that probably points to continued strength in the Canadian dollar. The drivers for the currency are energy prices, non-energy commodity prices, and interest rate differentials. And right now it's a commodity price story. As we go forward, probably more story later this year and into next year. We do think those interest rate differential story will come to the fore, and we think the Fed, the U.S. Central Bank, will be the first to be raising interest rates. Again, not until next year, but ahead of other central banks, including the Bank of Canada. So we should see a bit of recovery for the U.S. dollar, and alongside that, slightly more competitive Canadian dollar. So for Canada, the export market, even with a firming, softer currency going forward, we'll see that support translate into better export numbers. And with that, it should contribute to some pickup in investment activity. Investment, obviously, with the elevated levels of uncertainty, has remained very weak. But if we look at the corporate balance sheet, the corporates in Canada, as they are in the US and other parts of the world, flush with cash, and all this money will eventually get put to work. Some of that goes to share buyback, some of it dividend payouts, some of it M&A, but some of it will also end up in investment activity, and that'll pick up, particularly as the uncertainty levels ease on a go-forward basis. So export investment doing some of the lifting for Canada, but the key driver for Canada, which has been the story last year and will remain the story, is the consumer, and a similar story in the US. And when we look at the US, sizable fiscal stimulus. So with the change in the administration in the US, from a Canadian perspective, there are a few files that we're looking at fairly closely. Energy, obviously one of them, though we've already seen that largely play out with the end of the Keystone project. But the other components we're looking at is stimulus from the US. It looks like it's a much larger package than people thought only a short while ago. That's going to go into the economy, and that's going to give the economy an added lift at a time when households in the US are also sitting on a ton of cash. So we're going to get some pretty sharp numbers, government support continuing through the course of this year, which will probably start to raise growth forecasts, albeit they've started, but we'll see more aggressive changes on that. And if it's good for the US, obviously it's good for Canada. And we'll also look at what's going on in the trade file, arguably a more predictable trade environment with the Biden administration relative to the Trump administration, and also more of a focus on multilateral for Canada, large exporting nation that we're not huge political economic weight, so we tend to do better in a multilateral world than a bilateral world. So we'll be watching that development as well. And then finally, with respect to a smarter and greener economy and the context of a Buy American, Canada has to get a toehold in that and turn it more into a Buy North American. We have lots of opportunities beyond just commodities needed for some of the green tech, clean tech that is likely to be front and center for the Biden administration. So U.S. growth prospects encouraging, continue to be revised higher. And that bodes well for Canada as we move forward. Like the US, the Canadian consumer is actually in better shape now than before the crisis. The savings rate has ballooned up quite significantly. In 2019, the savings rate in Canada averaged 3%, got to 27.5% in the second quarter of last year. In the third quarter, pulled back a bit to 14.5%. But estimated $200 billion in excess savings sitting with the Canadian consumer. And as we go forward, that money will continue to be released in the economy, and that explains a good part of why consumer spending and most components of consumer spending are very much a V-shaped recovery. Consumer spending, retail sales above year-ago levels and continuing to move higher. When you look at the components of that, your industry in particular is the strongest of all the industries that they release on retail sales, and that sales there are up just over 20%. So continued strength there, as Jeff had suggested. There's this nesting pattern taking place in households, and individuals are taking that money. Some of it comes from employment, some of it comes from government transfers, and some of it comes from spending that would have otherwise taken place in restaurants and travel, which are restricted right now. So that bodes well for the consumer. And as we go forward, the consumer will continue to support growth and living off these savings. And when you look at the key driver for those savings, it's government fiscal stimulus. So we have data now for 3 quarters of 2020. In the first 3 quarters of 2020, wages and salaries earned by Canadians fell by $35 billion. Federal government transfers to individuals over those 3 quarters rose by $97 billion. So a multiple of the wages and salaries lost was replaced by federal government. And with that, we've seen the savings rate spike higher, debt to income ratio now lower, and net wealth, because of housing, because of equity markets, the wealth of the household is also better. So on average, better position, not obviously evenly shared. The employment gains have been disproportionate to those individuals making more than $800 a week, but still a fairly strong consumer sector as we move forward, and momentum we think will continue. And that's been reflected in the housing market, which, initially with the shutdowns and the shock to the economy, it cooled off quite sharply. But then as the economy reopened, as confidence returned, reflecting some of these support measures, but also a low rate environment, we saw the housing sector snap back quite sharply. And if you look at the sales to listing ratio in Canada, it's at a record high, which suggests we're going to continue to see price momentum over the near term. And as we move forward, there's still long-term support that's likely to remain from low interest rates. But we're also in an environment where immigration, which in the past was a key driver for population growth, for household formation, and for the housing sector, immigration's tracking about half of the targeted level. So as the borders reopen, as the processing takes place, albeit maybe a little more challenged environment for Canada if the US opens up a little more to immigration under the current administration. But overall, I think the housing sector is going to continue to have a tailwind through the course of this year. As we get to the later end of the year, as mortgage rates move higher, as pricing becomes a little more expensive, then we'll see some cooling in the housing market. But over the near term, very strong momentum, and that's going to continue, we think, as we move forward. When we look at the fiscal support, we'll get a budget in the next couple of months. Our messaging to the Minister of Finance has been fairly consistent, is that given the recovery is tentative and vulnerable, now is not the time for tax increases. Tax increases will potentially roll over a vulnerable recovery. It also works against government support programs. It doesn't make a bunch of sense of government supporting the economy on one hand and pulling it back with tax hikes on the other hand. And then arguably any tax increases rarely achieve the dollars return that many had expected. So you won't get the big lift there as some would suggest. So it doesn't fit in with the growth agenda, which is what we need right now. If we don't have economic growth, we don't have it doesn't help with the sustainability of debt and deficits, nor does it help in redistribution, growing that economic pie that we all share. So the government's going to continue to support overall economic activity over the near term. But as we move forward, we cannot run deficits on the order of $381 billion forever. So that government spending has to get right-sized, and our push has been to get it right-sized and look at what government spending does in terms of long-term growth prospects. So their infrastructure is one of the key components, and not just hard infrastructure, but also smart and soft infrastructure. So internet access, support for industries that are adjusting to this new environment, tech adoption for the retail sector to get more online versus bricks and mortar, and then also a large part of the labor market with significant run-up in long-term unemployment. We need reskilling and upskilling opportunities too. So there are opportunities there that the government can help support alongside of activity from the business sector. Finally, in terms of interest rates, the Bank of Canada really did what most central banks did last March, and that was get interest rates to around zero. We saw 350 basis points cuts to 25 basis points. Back in March. In April, the Bank of Canada went down the path of quantitative easing, which is something they did not do post-global financial crisis. And then more recently with the new governor in June, we did get this forward guidance. So a commitment from the Bank of Canada to hold interest rates at 25 basis points until the economy is back at potential and or inflation is back at target. And using the Bank of Canada's own forecast for growth and inflation, that suggests interest rates from their forecast will remain at 25 basis points right through till 2023. We think the risks of that are probably to the earlier side, but really not a story this year, and arguably not until the second half of next year. So very low overnight interest rate environment in Canada as we move forward. Market interest rates will face some upward pressure. We've seen that lately. There is this inflation worry that we have seen some evidence in terms of commodity prices, but those commodity prices have to repeat those increases year after year, become inflation, but they will have some base effect, which push headline higher. But overall, I think with the economy operating below capacity, with the unemployment rate still elevated, we're not in an environment where consumer price inflation takes hold and lasts long. Having said that, with the large liquidity injections, massive fiscal debt and deficits, what we are going to see in the period ahead is similar to what we saw post-global financial crisis, is although consumer prices weren't to worry, we will continue to see ongoing asset price inflation, and that's probably with us for a while. So, Jeff, why don't I leave it there and turn it over to Charlie? Thank you.
Yeah, thank you very much for the Canadian perspective, and we'll get back to keep your questions coming, folks, and we'll get to them after Charlie's presentation. But thank you for the Canadian perspective, and for the a little closer to the industry, but a little further from home, our best friends to the south for the American perspective, Dr. Charlie Hall.
All right, thanks, Jeff and Craig. Wow, that's what a great overview. I could almost say ditto and leave it at that. But let me focus a little bit closer to the green industry in some of these comments, because I have various peer groups that I manage in the industry, and the primary one being grower related, and it's called the Eagle Group. And I surveyed the alumni of that peer group towards the end of the year. And I was asking them all kinds of things about how their business was impacted by COVID. And the primary one, and again, this is December. So after the entire year, which, Jeff, you really hit the nail on the head, that early on, we weren't sure whether we were essential or not. And there were governors around the country that said, nobody's essential. And others were saying, yeah, you're essential, you can be open. And it just really... it was disconcerting because, Jeff, as you well know, the industry is essential. There's no reason for this industry to be shut down because of the health and well-being benefits of plants. I mean, this was a health-related crisis, or is a health-related crisis. And last year I wrote 4 journal articles, 1, 2, 3, 4, on simply the health and well-being benefits of plants. Now, I've written previous journal articles on the environmental ecosystem services benefits of plants and the economic benefits of plants. But last year, I tried to summarize all the health and well-being benefits of being surrounded by plants and improved landscapes. I tried to summarize it in one document. I couldn't do it. I had 4 journal articles, just one on the physiological benefits of the human body of being in the presence of plants. It's pretty amazing in terms of stress reduction. Cortisol levels in the body go way down. And kids with ADHD, if they're out in one of your improved landscapes, for the folks that are online, it has the same effect as 2 of their medications neurologically. So, I mean, Jeff, we're talking about some significant health and well-being benefits. So we saw that because of the staycation effect in people staying at home, working from home. They were looking around their landscape. Hey, I need to improve that. Looking inside their home, I need to decorate with these plants. I can put some succulents over here. So we did. We saw, Craig, in this specific sector, we saw in both the U.S. and Canada just a boom, particularly in the latter part of the season. And so this peer group, when I was surveying them, when I was asking them what percent of normal capacity, basically 90% were at 80% capacity or above. And when I focused in on sales specifically, Jeff, it was kind of a bell-shaped curve, in that it went from 0 all the way to up more than 25%. And you had, again, a kind of a bell-shaped curve there, and the number of growers in those respective sales categories. Now, I did have about 10% of the growers that were down year over year, but that was only 10%. And most of those that were down tended to be those that focused on the green infrastructure market. And a lot of those shovel-ready projects, well, as soon as COVID hit, they were shelved or at least postponed. And so growers focusing in on that green infrastructure market really took it on the chin. Everybody else came out pretty good. And when you go down to net profit, it's that same bell-shaped curve. It's a little bit lower, of course, but there's 25% of the folks that responded had year-over-year net profits of greater than 25%. Now, there's a lot of reasons for that. And the folks that are online, whether you're a grower, landscape service provider, retailer, what have you, you're probably in the best working capital position that you've ever been in your company's history. With particularly here in the U.S., we had the payroll protection program that injected a lot of cash. We had some relief from USDA that was also provided. So particularly here in the U.S., working capital is not an issue. And from talking to my friends, north of the border, they're in much better working capital position than they've ever been. Of course, that's one of the trifecta in terms of green industry businesses, having enough working capital, making sure that your labor is efficient and that you can find the labor. And then thirdly, you manage that shrink. And by and large, if you do those three things, you got a good shot at making money. Now, I'm just keeping track of the chat box here to see if there's any questions that pop up that I can answer. They'd say most government officials not essential and hindering. Okay, well, we can argue about whether government officials are essential or not, but I know green industry businesses are always essential. So that's the only thing I care about. All right, so I asked them about net profits, and then I asked about their pre-bookings for this spring 2021, and about 23% indicated their bookings were well ahead of last year. 32% said that they were up slightly compared to last year, and then the remainder were, basically where they were. Now, Jeff, one of the things that's kind of disconcerting is the fact that when I talk to young plant growers, all the ones producing plugs, cuttings, tissue culture, liners, whips, and so forth, all those young plant growers were saying, man, our sales have been stellar. And, I don't have the numbers to say how much year over year that those sales were up, but most of them said by double digits. And here's the conundrum. Those young plants magically get transformed into finished plants. And we as an industry have always been very adept at taking moments of plant shortage, which we saw during COVID, right? We saw some shortages in certain categories, certain perennials, certain annuals, certain trees that were in short supply. But we've always been very adept as an industry of turning that shortage situation to a surplus situation. So that I got my eyeball on that in terms of how that's going to play out this year. And the big question is, will the consumer, that homeowner, will he or she act the same way that they did during COVID? Because if you ask retailers, and my friend Danny Summers manages the Garden Center group, and that's another peer group just for garden centers, their year-over-year sales were up anywhere from 23 to 37%, depending on the region of the country. And there's some Canadians in those numbers as well. So that's year-over-year sales. Their average transaction count was up year over year, and dollars per transaction was up year over year. So retailers had a good year. All right. So they should be going into the year with better working capital as well. Landscape service providers, it's a little more of a mixed bag. About 40% of them indicate in some informal surveys that their sales were basically status quo. And it really depended, Jeff, on what part of the country they were in and whether they were part of the essential businesses that were left open early and whether they weren't. The rest of them, however, were up, by double digits year over year in terms of both sales and profit. So again, you take that for the industry and you combine allied trade into it. It's a pretty darn good year given as a pandemic. And it's, it's one of those things where we never wish ill will on other sectors, but at the same time, we've gone through our fair share of being behind the eight ball when everybody else was doing good. So we had that little bit of a turn. And so we did pretty good in spite of the fact that face-to-face service businesses in particular took it on the chin. So there you go. So that staycation effect, again, the big question is whether the consumer is going to do that again this year. If they do, Jeff, it's going to be a great spring. It's going to be an awesome spring because, again, our working capital is not an issue, and we should have the plant material. So if the consumer responds, it should be a pretty good spring for us. Now, in all of my talks, I always say that the shape of the economic recovery is directly correlated, inversely correlated to the shape of the COVID curve. And fortunately, we're seeing here in the States and in Canada, the COVID situation get much better. And now that we have a sane administration in place, wait a minute, did I say that? Sorry. Now that we have a game plan for vaccination in place, then more people are being vaccinated. We should start seeing the results of that in terms of the economic outlook, as Craig was saying earlier. So we're very optimistic in that, and that we can reach herd immunity by perhaps the end of summer if we can get at least 64% of the population vaccinated, which is, you'd think, well, that's just a given. No, in fact, some of my grower peer group, again, and some of the surveys that they were doing, they were surveying their employees as their willingness to be vaccinated. And all of their H-2A workers coming from Mexico or Honduras or Guatemala and so forth, almost 100% of them said, yeah, I'll get vaccinated, no problem. Only 55% of their domestic workforce was said, yeah, I'll get vaccinated. The other 45%, no, I'm not sure, definitely no, right? And that's because here in the U.S., the vaccination has become as politicized as masking, unfortunately, right? So there's all kinds of, as you know, it depends on who's saying what and as far as what the truth is. Now, labor, as Craig said earlier, the higher income earners have done fairly well. And they were able to maintain not only their jobs, but salary levels and so forth. In fact, they have, if you look at the unemployment of everybody making over 80,000, they have gotten all their jobs back, and then their employment's up 1.2%. You've got the folks making less than 60,000, and particularly those making less than 40,000 US, that their unemployment's still way down. Right, so it's not been an equal impact on the families by any means. Housing's been strong, like Craig. He had all the numbers, and it mirrors that in the U.S. We have a dearth of houses on the market, and it's supply and demand. Right, you have short supply. We got 1.2 months worth of supply of houses in the pipeline. That's ridiculous. We've never had that low of a supply, and so with the demand has been very strong. Which has caused housing appreciation. And in fact, houses are 46% higher in their housing prices. Of course, that's the National Case-Shiller Index, the 46% higher than what it was in 2007 prior to the Great Recession. Prices are 46% higher. So I got my eye on that, but the underlying fundamentals, again, Craig alluded to this, so I won't repeat it, but the underlying fundamentals are much better now than what they were then. And certainly in terms of liquidity in the financial sector. And so the financial risk index is really pretty low given the conditions. And so I'm not too worried about housing. The millennials have been pushing that housing demand, as well as the high income earners. And of course, you got mortgage rates at ridiculously low rates. So those three factors have mainly pushed the housing demand. And of course, we like that because every house built, you got to have flowers, shrubs, and trees around it. And usually when it's sold, there's some sort of landscape renovation going on. So we like it when the housing sector is doing well. From here, the economic recovery's correlated to COVID. There's going to be some pent up demand. When I draw my air graphs, right, of the second quarter collapse and the third quarter gain, that's Craig said, that's the V-shaped portion of the recovery. But we had 31.4% seasonally adjusted annualized numbers decrease in the second quarter, 33% increase in the third quarter, 4% the first estimate on GDP in the fourth quarter. And as 2021 plays out, it should be a relatively strong year, provided we can get, folks vaccinated and develop some herd immunity. So economically, we're looking at some pretty good conditions. Now, when I look forward and say, how's all this going to affect the green industry? Well, again, that undersupply of houses and that pent-up demand means that demand for flowers, shrubs, and trees is going to be pretty good. We know there's going to be some continued strain on the energy sector. Craig said we saw the immediate impacts of the pipeline announcement and so forth. And so, again, OPEC and Russia are playing games politically. And so Saudi Arabia is the big unknown, how they're going to react and everything. But diesel and so forth, natural gas, electricity prices be higher in 2021 than they were in 2020, but so will everything. And Craig alluded to this as well. And we saw, I calculate an index of prices paid for the industry. This is very similar to the index of prices paid that USDA generates for farmers. But I look at green industry inputs specifically: containers, labor, freight and trucking, plant protection products, fertilizers, all the inputs that go into making flowers, shrubs, and trees. And I develop an econometric model for each one of those sectors, and then weight each one of those items by the benchmarking data that I collect through my industry benchmarking, because I collect income statement, balance sheet information from folks in the industry. So I weight them by the relative importance in the total cost structure of the firms, and then generate this index. So last year, 2020 over 2019 is only 0.5%, 0.5% increase in the cost of those inputs. The previous year was about 2.3%. But I also developed a forecast. And my forecast for this year is 5.24% increase in the cost of inputs. Labor, my index relative to 2007, which is my base year, I set it at 100. Labor is 50.8% more expensive today than it was back in 2007 before the Great Recession. And of course, freight and trucking is another 35%. That's more expensive than what it was prior to the Great Recession. So for 2021, the inflationary effect on commodities that Craig was talking about, for green industry specific inputs, we're looking at about a 5.24% increase. So Jeff, if firms are out there and they're not increasing price, and those input prices are increasing, input costs are increasing, guess what's being squeezed out of the middle? Margin. All right, so that's margin compression. So I only say that because it's not too late to look at your pricing for this upcoming season and to make adjustments if you need to, anticipating those types of increases. So now, Craig talked about inflation and the dampening. In fact, one of the questions in the chat box was asking about why didn't inflation rear its ugly head in the 10 years past the Great Recession? And there's a lot of answers of that, and a lot of financial macroeconomists are still scratching their head over why hasn't inflation been more prevalent. But it does provide the posturing, as Craig said, for the Federal Reserve to not want to raise rates until we see a year's worth of the personal consumption expenditures, the PCE index, at about 2%, which is what their trigger is. So they want to see a year at 2% before they even think about raising the interest rates. That may change depending on economic movement in the latter half of the year. But I think Craig stated it well, that we're looking at 2023, right, Craig, until before any modest adjustments in the interest rates that are stimulated by any inflationary effects. So what else can I say about, again, shrink, labor, working capital? That's always the trifecta for green industry businesses. I think we're really pretty good in terms of working capital. Got to work on labor. It's going to continue being constrained in terms of availability. And then, of course, the cost of labor has been going up and up and up. It's 50% more expensive than it was back to 11 years ago in 2007, 12 years ago. So you got to manage those things over time and keep the banker your friend, right? But you don't want him to be so much of a friend that the bank has more skin in the game than you do. You don't want to be over leveraged. That's what got folks in trouble before the Great Recession. So make sure that it's a good time for growth, but don't grow to the extent that you get over leveraged. And that's that's a subjective measurement, but I typically look at leverage ratios around 2.5 to 1. Anything above that, I get a little nervous. But anyway, I'll stop there and we can do some Q&A.
That's amazing. Great perspective, and thank you so much. I think what we'll do is I'll manage the questions over on the chat, so folks keep bringing them in. But let me kick it off, and maybe we can both Charlie and Craig can riff off of each other on this one, because we're talking a lot about housing, and I think a lot of our members would be wondering longer term, what are we forecasting for how people are going to live beyond this pandemic? Is remote working here to stay for the long term? What does this mean for people, especially where they choose to live, since that is such a critical factor to how to our industry and whether they need plants, trees, flowers for their yards, where they won't need them for their condos. What are your thoughts on that, gentlemen?
I can start, Charlie.
Yeah, go ahead.
So a few things. So when we look at work from home, there's the extreme scenarios of everybody goes to home and everybody goes back to work. And I think there's going to be something in between. So this hybrid model is probably the most likely outcome. And there are some surveys being done in Canada and I'm sure elsewhere around the globe. But in the Canadian context, when employees are surveyed, about 80% of them want a work from home option. When you ask businesses, about half the businesses don't have the option of having people work from home, but though that 50% that does have an option of working from home, there are only about 25% of them are willing to offer that. So there's going to be a tug and war as we go forward, and I suspect we'll end up in some sort of hybrid model. And there are benefits for density in the office. There's economists talk about agglomeration economies, so that the mind exchanging ideas and innovative thinking. That all works in an environment that's less effective as over a Zoom call or phone calls and the like. So there will be something, a hybrid model of manner. In the interim, what we have seen, and it's already begun in Canada in the housing market, is people are looking for space, and that's in terms of size of footprint of the house, which is explaining some of the move we've seen from multifamily condo space to single family detached, and then also from more urban settings to smaller urban settings or more rural settings. And that's been a trend that's been in place. So you look at the major city markets in Canada, Toronto, Vancouver, Montreal, house prices have shot up, but within a short commute, house prices in those smaller markets have even shot up further. So we're already seeing that. And of course, the supply there and the infrastructure is not built for the amount of people that are looking to move there. So we're going to see some pressures on that front as we go forward. But I do think that there is a component to work from home that's going to stay. Right now, Canada has 5.5 million Canadians working from home. More than half of them never did before. And I think we'll see a continued hybrid, that people will be working from home and from the office. And that suggests to us that, we'll see a little more strength in space of the housing sector, i.e. detached, and the more rural settings. And the housing sector, just to pick up on some of Charlie's comments, we did that Charlie mentioned 40,000 US or 769 a week. Canada's the $800 thing too, the so-called K-shaped recovery, that high-income households in Canada, the highest cohort, didn't even see a decline in employment through this. They're higher tech, higher service touch, less touch, and they were continue to see job gains all the way through this, and it's a lower income household. So high income households, job gains were there. Some government transfers probably ended up in their pockets, and all they've seen out of this crisis is a very low interest rate environment with excess cash on hand. So that explains, I think, part of the strength we're seeing in the detached market relative to multifamily, and the work from home is a component explaining that gap as well.
Yeah, and let me tag on there and talk about it from the perspective of the green industry. The commercial real estate sector is obviously going to be lagging behind residential. So I'm thinking landscape service providers, particularly, depending on the mix of your residential versus commercial clients, it may impact your business either more or less, right? If you're mostly residential and you're seeing this growth on the residential side, life's going to be great. But if 80% of your business has been on commercial contracts before, you're going to see some pressure there because of the commercial real estate sector lagging behind the residential sector. So that's my biggest concern there, is that the effects on the commercial real estate market, and it always lags behind the recovery in the residential. Again, that's my biggest concern.
Charlie, just to talk a little bit about your local area there, and especially areas like Austin that are seeing immigration from places like California, and the cities are booming. We don't see that as much here, although in certain parts of Canada, you're seeing, because of this work from home phenomenon, you're seeing that you can basically work anywhere. So you're seeing places like the Maritimes that have never had a housing boom in their history are finally getting a housing boom. You're seeing that in your areas as well down in the U.S. Cities that weren't so popular before. Maybe it's taxes or whatever the reason is, but you're seeing that phenomenon as well.
Yeah, there's been, of course, in the media, a lot of attention placed on some billionaires moving from the Pacific Coast over to Austin, Texas. And at one time, 114 people a day were moving to Austin, Texas. And that's kind of disconcerting from a statewide water concern, because we already have pressures on our water reserves. But that growth has slowed down a little bit, but it's still there. One-way U-Haul rental to San Francisco from Austin is about $198 US, and to go from San Francisco back to Austin, it's over $1,000. So it's supply and demand.
A lot of one-way trips.
Yeah.
Craig, I'm going to throw one at you out of the chat straight up. I'm sorry, folks. We are 16 minutes left in this, so we're gonna try and burn through some questions as quick as we can here. Let's talk Canadian dollar. Where are we going in the shorter term versus longer term? I know you talk softness. Can you any numbers that you can share with us?
Yeah, economists will never give a number and a date together, but I'll break that golden rule. So we have the Canadian dollar at the end of this year at 130 and the end of next year at 133. So a slight softening tone. As I said, historically, it's three drivers: energy prices, non-energy commodity prices, and interest rate differentials. And to date, it's been initially a non-energy commodity story, and then more recently, the energy prices with WTI spiking higher. But as we go forward, I think that interest rate differential will speak a little more forcefully in equity markets or in currency markets, and that should provide a bit of a tailwind for the U.S. And the flip side of that is a slightly softer Canadian dollar, but not a dramatic move from where we are, just maybe a slight softness.
Thank you. A lot of talk about inflation in the chat. I know that you touched on it. Can you both give kind of a real synopsis on what's going to happen with inflation over the next 12 months? What do you see happening there?
Yeah, I mean, over the near term, it's moving higher from a very low base. We're going to continue to see these base effects on some of the key components. WTI March, April last year went negative. It's not negative now. So just those level changes are going to have a feed through. So we're going to see that base rate continue to drift higher. And with that, we'll get to the north of the 2% target the bank has, or the Fed has the PCE deflator. But then as we move to the latter part of the year and beyond, We think that the predominant forces determine inflation is where the economy is relative to where it could be, i.e. our potential, and we're still below that. With our growth forecast, we have the Canadian economy getting back to where it was pre-crisis at the end of this year. So there's still capacity in the economy. In that environment, businesses don't really have a lot of success in passing on price increases, though, as Charlie suggested, you may want to try that. But your industry is in a particularly strong position than some of the other industries. And then secondly, the job market. We're seeing the unemployment rate. The U.S. has made better progress on the unemployment rate. Canada's at 9.4. In January last year, we were at 5.5. So, by the end of next year, we have the Canadian unemployment rate getting down to 6%. When the unemployment rate's high, elevated, workers tend to look more for job security over wage gains. So we won't see them pushing for aggressive wage increases, we don't think. And then finally, inflation expectations. And this is the one to watch, because traditionally over the last decade, everybody's worried about inflation, and most central banks with the target underachieve that target. And now the Fed, as Charlie suggested, and the Bank of Canada is looking more flexible as well, is they're probably going to want to see inflation run a bit hot for a while. Just to sort of squeeze the labor market as tight as it can be, and bring in some of the labor that's been displaced, and they're disenfranchised, and particular minority groups that are impacted by this, women as well. So they'll probably want to run it a little hotter for a little longer. And the risk there is inflation expectations, because if you get from 2 target and you start sneaking up to 3 to 4, it gets harder to pull it back. So it will be something to watch. And I think the bond market, as we've seen lately, it's going to be driven mostly by inflation expectation stories. And I think the Fed and the Bank of Canada are not going to raise rates until they actually see that the evidence of inflation, I think, as Charlie suggested.
Yeah, and thank you. And Charlie, we talk about the uneven effect of the last year on certain groups within society,
right?
And for our industry, you've spoken a lot about labor, and why are we not seeing the migration of the lower side of the labor scale moving into our industry? What is going on, kind of macro, that we're not seeing the low wage folks moving from, say, the hospitality business over to the green industry?
Yeah, where normally we would start seeing that if things were down in the construction sector, for example, then labor became more widely available for our industry. We'd be able to entice them. We saw that during the Great Recession. Is that in 2006 we were talking about immigration this and immigration that, and comprehensive immigration reform, and where do we find labor? Then the Great Recession hits. Oh man, we're covered up in labor from the construction sector and other higher wage paying industries. All right, so that's and a lot of rhetoric about $15 minimum wage, US dollar minimum wage, and interestingly, the latest farm labor survey, the average farm worker was already at $15.42 in terms of across crop and livestock industry. So agriculture is already there. But why aren't we seeing that shift? There's some contention, and this is anecdotal, that some of the policies that were put in place, the CARES Act, for example, that artificially raised wages in the short run so that they were above where they traditionally have been. And so there was some contention that because folks had the pandemic unemployment assistance and the pandemic emergency compensation program, that they could actually earn more by staying at home than actually going to work, going back to work. So there was some anecdotal evidence of that, but that was strictly anecdotal. There was a Yale study conducted at Yale University that disproved that. But I've got green industry businesses that'll swear up and down that they can't get some of their folks that they had hired back to come back because they're better off with unemployment. The other thing is that the social distancing and so forth has put some constraint on hiring, but I think we're through that phase of that constriction. But those are the two main things that come to mind, Jeff, in terms of what's been headwinds in terms of attracting labor. But our industry has always been on the short end of the stick in terms of our wage levels. So the supply and demand does work.
Yeah, it sure does. It's always a question. Why can't we just get more cheap labor? But it's because it's cheap labor.
Yeah.
Let's move over to taxes for a second. And all this government stimulus, Craig, where is the government going to hit us in terms of getting all this money back? Where do you see taxes being increased to pay for all of this?
Well, I mean, the worry is everywhere, but I think, you know, as I suggested, we do these pre-budget meetings with our finance minister federally in most provinces, and the messaging we've been giving is, as I suggested, now is not the time for tax increases. The economy is still, you know, as I suggested, vulnerable. Tax increases rarely raise the money that the proponents of them suggest. So what we've been suggesting is, well, as we move forward, government spending is going to be right-sized, and that'll get the deficit on an improving trend, especially if they focus on the growth-enhancing investment, and that's what we've been pushing for. But while that's taking place, to take the time to look at the tax code and make sure that the tax code that we have in Canada is a tax code that's built for the future economy rather than the economy of the past. And there's lots of opportunities, but you know, we can do some smarter taxation. So government revenue is no different. So tax reform, lean more on consumer taxes versus taxing savings and investment. So, you know, look at those options, and won't change the size of government revenue take from the economy, and actually could enhance productivity of the economy, which grows the economy. So tax reform, I think, would be looked at first before any sort of look at tax increases, and the restrictions on how big these deficits are and how big the debt is. The rules have changed a bit there, and you know, we've traditionally looked at, you know, what how big is too big is, well, you look at rating agencies, and you know, Canada's well positioned, US well positioned. You look at relative, so Canada was below the OECD average in terms of debt to GDP. We've caught up, but slightly better, so we're not any worse than others. But most importantly, I think in the current environment is with central banks looking at quantitative easing, so they're buying up large pieces of government debt. And in Canada's case, the Bank of Canada did not do quantitative easing during the global financial crisis. We're new to this game, and they did it in size. So now, you know, when you look at how much debt is too much, traditionally you looked at investors' appetite to hold debt, what was going on with yields and spreads and currency. And now we have a very new, very large, and very patient investor in the government of Canada's securities market, and that's the Bank of Canada, that owns over 36% of all outstanding debt from the Bank of the Central Bank of the Department of Finance. So they're not going to be fleet of foot when they get any nerves about inflation or about how much debt is too much. So the rules have changed a bit. So those earlier sort of thresholds on how high was too high, those goalposts have been moved. We're not where the U.S. is, being reserve currency and the like, but the old rules we're through where we were in previous downgrades. Canada's debt to GDP is about 100%. 94, we got downgraded by S&P. And the Wall Street Journal called us the Northern Peso. So we're through those levels, and no negative comments yet, but stay tuned.
Well, Charlie, with a $1.9 trillion stimulus package coming your way, up to, let's say, 1.9 trillion. What are you thinking on taxes, or what are the folks down there thinking?
Well, obviously there was a $900 billion package passed in December, and about a third of that was to go back to PPP Part 2 and to provide other assistance for small businesses. So the breakdown on the 1.9 is still being fleshed out in committee. So I haven't seen the final numbers on it. There's always that concern. It's interesting when you have an administration changeover. Now all of a sudden there's a different mindset on the Republican side of the fence, and as austerity is all back in vogue, right? And even though the Tax Cut and Jobs Act back in 2017 really increased our national debt considerably. It was supposed to generate $1.3 trillion in additional corporate income taxes, but that did not pan out because instead of investing in people and equipment and buildings and so forth, there was a lot of dividends paid out and stocks bought back. And so that was of course, we economists were saying this is a poor policy to enact at this time of the business cycle. And they didn't ask our opinion. So there's this worry about the size of the national debt, but there's a bigger worry of getting through a pandemic. So in the short run, Janet Yellen said this, I think, perfectly, now Treasury Secretary. I think she was one of the best Federal Reserve chair people we've ever had. But she said, you got to get through the pandemic, and then we can address those issues a little bit later. We will have to pay the piper at some point, but it's until interest on that debt gets to be larger than some of the social safety net programs, Medicare, Medicaid, and Social Security. There's still a little wiggle room there. So as far as inflationary pressures, I think Craig said it best. I can't add to anything he said there. We'll deal with those hands when we're dealt with them. But in the meantime, let's make hay, because the hay's out there to be made right now. So let's do it.
Absolutely.
Jeff, can I just jump on
course.
on the last point with respect to inflation and interest rates? So when you look at sustainable debt to GDP is the way we look at it. So debt relative to GDP. Debt grows at nominal interest rates. GDP grows at nominal GDP. So as long as growth recovers and nominal interest rates remain low, that math turns favorable. We've seen the vicious side of it. Now going forward, we'll see the virtuous. So the numerator, debt, is growing at nominal interest rates, which they've moved higher, but they're still at multi-generational lows. And now we're looking at pretty strong growth. We're talking real growth. You had a couple points for inflation in there, and you're getting some pretty impressive nominal growth. So that denominator, GDP, is going to grow pretty impressively. So the worries about debt and GDP are going to be less of a worry going forward until growth falters and or interest rates spike. And right now, all governments are playing that game.
Do they keep the money flowing over the next short period, Craig? Do we see the wage subsidy programs, et cetera, extended beyond their current life, which I think is to the end of June? Do we see that continuing?
I mean, it depends, right? It's all about replacing what's been lost by closing the economy. And as we go forward, it's all about vaccination. So, Charlie talked about U.S. experience of vaccination. If our government's correct and the deliveries come as they suggest, we get 14.5 million vaccinations in Canadian arms by June, that will take care of everybody 50 years and above, which is where the lion's share hospitalization come from, and where 99% of the deaths have come from. So you don't need herd immunity to have the economy open up again. You just need to take out the high risk sector. And Canada's been disappointed sort of day after day in terms of the vaccine rollout. But at some point, maybe things will turn to favorable, and we'll get on top of it, open the economy, and then some of these programs can wind down, and then consumers will rely on the old time jobs and income gains to continue to support growth.
Well put.
Wow. Interesting. So we have 2 minutes left. We're now down to 1 minute, and we may want a minute or two over. I'm just going to ask you in 30 seconds, gentlemen, your greatest learning over the past 12 months, and either one of you can kick that off. What do you know now that you wish you knew, or what is your greatest learning over the past 12 months?
Well, Craig, I'll let you start again.
Oh, okay. Thanks. Greatest learning. I guess, it's easy to criticize government policymakers, but I have been impressed at how quick and agile and aggressive the policy response was to this air pocket in the economy. So from a policy perspective, closing it down, we've never seen large parts of the economy close down like this before. And rarely do we see it in the service sector. Usually we see recessions in the goods sector. So we shut down the biggest component, more than 50% of jobs and GDP from the service sector, shut it down. And we saw central banks cut rates to zero. Bank Canada moved down quantitative easing, didn't do post-global financial crisis. And the Department of Finance, they were putting together programs over the course of a weekend that would usually take years to study, getting it out the door, and then course correcting as feedback came in. And I think that mitigated a lot of downside. And now with the speaking to the agility, vaccine production and approvals was also very aggressive. So it's been kind of refreshing to see how quick policymakers responded to this, and arguably they did more good for the economy than otherwise.
Jeff, the biggest eye-opening thing for me was related to that essentiality that I opened up with, and the fact that for 10 years, over 10 years now, since 2010, I've been collecting every piece of information, every research record that is in the literature regarding the economic, environmental, ecosystem services, and health and well-being benefits of plants, because it was my contention that our industry's value proposition needed bolstering. We've relied too long we enhance the beauty of landscapes. We grow pretty plants. That value proposition, if we look over the long-term sales in a mature industry, it wasn't cutting it. We weren't getting the growth in usage of plants, flowers, shrubs, and trees that we needed. So I thought we needed to bolster our value proposition as an industry. And so I've collected well over 3,000 research citations, and much of that from the medical profession and the psychological profession who have really conducted the benefits conducted a research to our benefit. We didn't have to pay for it, but there's study after study that shows how essential our flowers, shrubs, and trees and improved landscapes are. And yet, in the midst, when it came down to push versus shove in the midst of the pandemic and deciding who was essential and who wasn't essential, it's quite clear that our legislators did not have that same level of appreciation for the value proposition of this industry. So it told me that we have a ways to go in terms of influencing the inelasticity of demand for our products, and in order to make them inelastic. And so we had not done as good a job as what I thought we had done. So that was the biggest eye-opening, is that we still have a ways to go in terms of influencing people as to how essential we are enhancing the quality of their lives.
That is very well said. And there's, we did bring millions and millions of new customers to our industry over the past 12 months. And I think that our job
we always do that. In previous recessions, we've seen that same bump in that shot in the arm.
Yeah.
But our industry's been notoriously bad at keeping those customers. Yeah,
absolutely.
So this is the litmus test, Jeff, this spring, in terms of how well we did last year as to how many of those newbies come back. Sorry to interrupt you there, but
but you're absolutely, that's our job at this point going forward. So we are here at an hour. That's the fastest hour I've ever been through. So I hope that you all found this to be as informative as I did. And I hope that all the information that you learned today can help you make smarter business decisions going forward. It looks like it's going to be a very exciting year for our industry. So while demand is through the roof, please be sure that you're keeping your teams safe, your customers safe, and especially your families. As the COVID task force, we will do our best for Landscape Ontario's COVID task force. We will do our best to continue to keep you informed and help you navigate the challenges in public policy that will affect the workplace as they appear. And let me thank my peers and the LO staff on the task force led by Alan Wright for their leadership over the past 12 months. And if you can believe it, we've had about 120 meetings together since the beginning of this pandemic trying to get it right. And we've really gotten to know and I think respect each other quite a bit. I want to thank Craig and Charlie for participating today. It was amazing to hear two leaders in their industry sharing the most up-to-date information with us. And finally, let me thank Scott Barber and Tony DiGiovanni, who you're not seeing on the screen, but they're there for helping me organize today and looking after the tech. So thank you very much, everyone. Stay safe out there. Have an amazing spring. Thanks, Craig. Thanks, Charlie. Have a great golf game, Charlie. Tee off time at 2:00. All the best, everybody. You take care. Be good, everybody.
Right. Good to see you, Craig. Yep.
Good to see you,
Thanks, guys.